let me remind you the audit cycle, which we discussed in the first lecture, audit cycle. So if you see the audit cycle, it is, first of all, there's a planning stage after the ethical acceptance, and then you evaluate the internal control system. So the result of the internal control system may be that internal control system is strong or it may be weak. If the internal control system is strong, we do the less testing, and if it is weak, we do the detailed testing. Then there is review, and at the last there is report. So this is the audit cycle. This is actually the cycle of the audit. First of all, we do the planning, then we evaluate the client internal control system, and then we see the results, whether the results are weak or strong. If the results of the internal control system prove strong, then we are going to do the less testing, and if that proves weak, then we are going to do the detailed testing. After that, we do the review, and the last stage is we give the report to the shareholders. Okay, this was the audit cycle. So today we are going to start the audit planning, which is the first stage of the audit cycle, and the planning area is very, very important. As far as the exam is concerned, you may have three types of questions in the exam. The first may be MCQs, or you may say objective test questions. Then you may have a knowledge-based part of up to 5 marks from the planning area. And the third and the most important thing is, let me write this thing in a different color, that examiner is going to give you the case study. And the case study suggests that normally, or most of the times, the question we are having from the planning area is identify and explain the audit risk, or just explain the audit risk, or just identify the audit risk, and provide auditor's response. This is the requirement that you will be having almost, I can say, must in the F8 exam. So this question is somehow you can say the compulsory question in the exam. But you will be having the case study whose requirement is identify and explain the audit risk and provide auditor's response. This is you are going to get in the F8 exam in terms of the planning. So that means that in today's lecture, we are going to understand what is audit risk. And I am leaving the auditor's response part for the substantive stage, evidence stage, testing stage, because that has a logic and you're gonna get that later on, that why we left the auditor's response to the substantive stage area. There's a logic behind that, and we're gonna do that once we reach the substantive stage. Okay, I'm going to make a link. I'm going to make a link before explaining this audit risk, and you need to understand that link. First of all, what was the objective of the external audit? If you remember, the objective of the external audit was to provide reasonable assurance that financial statements are free from material misstatement. to provide a reasonable assurance that the financial statements are free from material misstatements and prepared according to applicable financial reporting framework. So that means basically we are going to give the reasonable assurance, reasonable confidence that the financial statement do not contain the material misstatement. They are free from material misstatements. And the financial statements are prepared according to the relevant applicable financial reporting framework. This is something we need to assure to the shareholders. So that leads to a point that whenever we are doing the audit of the financial statements, there are two risks. Whenever we are doing the audit of the financial statements, there are two risks. The first risk is that financial statements may contain a material misstatement. So this is something that you are being skeptical. You are being skeptical that you are thinking that the financial statements may contain a material misstatement. Because if you are not thinking like an auditor, you are not being skeptical, then obviously you are not going to find those misstatements. So first of all is that you have to keep this thing in your mind that the financial statements may contain a material misstatement. And the second risk is that auditor may not detect material misstatements. So if you see these 2 points individually, then I can say that if you see this first part, that the financial statements may contain a material misstatement is something which does not belong to the auditor. Like, I have nothing to do with this risk because this risk is coming from the management, that they may not have prepared the financial statements correctly. That is why there's a risk that the financial statement may contain a material misstatement. This is something that is different from the auditor. This is something that is not coming from the auditor. And if you see the second risk, that the auditor may not detect the material misstatement. So here we can say that this is something due to the auditor, that if the auditor is not actually able to detect those material misstatements. So what's going to happen? That if the financial statements contain the material misstatements and the auditor is not able to detect that, what's going to happen? That the auditor going to say that the financial statements are true and fair, and that opinion will not be correct because the financial statements were having the material misstatements. So if the auditor is not able to detect the material misstatements, then the auditor may give or provide incorrect opinion. The result is that the auditor may give or provide incorrect opinion, and this concept is known as the audit risk. So if you see the plain meaning of audit risk, that means risk in the audit. Audit risk means risk in the audit. So risk in the audit is that the auditor may give an inappropriate audit opinion. This is the risk in the audit. So whenever there is a risk, obviously because the auditor may give an inappropriate opinion, incorrect opinion, so that means the auditor will seek to reduce or eliminate this risk. Obviously, it is not possible to eliminate that, but still the auditor will seek to reduce this risk that the auditor may give an inappropriate audit opinion. How? Like, initially I have said that the financial statements may contain a material misstatement, something which is coming out of the management. The auditor may not able to detect the material misstatement, something which is related to the auditor. So first of all, let me describe that how I gonna reduce my risk being an auditor. I'll use the trained staff. I'll spend appropriate time on the audit client. I'm going to choose the sample carefully. I will ensure that I am applying the professional skepticism, etc., etc. So this is something that how I can reduce my own risk. But now coming towards that the financial statements may contain a material misstatements, how I gonna cater this risk? So the thing is that you need to take the understanding of the entity. In order to understand the risk of material misstatements, you need to take the understanding of the entity. So here I'm going to initiate a topic, which is understanding the entity. Means the client which we are actually going to do the audit, we have to take the understanding of the entity, understanding of that client. And what is the objective of taking the understanding of the entity is to identify risk of material misstatement. In plain words, I am going to understand those areas of the financial statements which may have the material misstatements. I'm going to see those areas. I'm going to be skeptical about those areas. I'm going to be careful about those areas which may have the material misstatements in the financial statements. So actually the objective of taking the understanding of the entity is to identify the risk of material misstatements. Because if I'm not taking a detailed understanding of the entity, then I won't be able to identify the associated risk. Like for example, let's take some examples. If I say that, okay, the client is operating in a technological industry. Say for example, they sell mobile phones. They are in a technological industry, and there is a continuous research and development going on every year at the client, because they are a technological company. So every year we see the research and development is going on. So how we came to know this thing? Because we took the understanding of the entity. So research and development, and you know the normal treatment is that research is expense out, development capitalized if criteria is met. The normal treatment is that the research should be expense out and the development should be capitalized if the criteria is met. So at the planning stage of the audit, you just came to know that, okay, they are doing the research and development, a significant amount is being spent on that. So being an auditor, you are concerned, okay, that this research and development should be accounted for correctly in the financial statements. And the correct treatment is that research should be expense out and the development should be capitalized if the criteria is met. Then at the planning stage of the audit, you are going to be skeptical and you are going to keep a risk in your mind that there is a risk that research may be capitalized or development does not meet criteria and still capitalized. Research and development. So what you have done over here is that you have brought the accounting treatment in your mind, and at the planning stage you are just being skeptical. You are just being critical that, okay, maybe they have not accounted for the research and development correctly, and they may have capitalized the research and they may have capitalized the development even if the criteria is not met. You are not sure whether this will be the case, but if you are not going to see this risk then at the substantive stage, you won't be able to test that. So just at the planning stage, keep this risk in your mind. And how I came to know regarding this risk is when I saw this research and development thing. And now taking the example of the same mobile phone company. Say, for example, if we say that they have the combined products. What are the combined products mean? Like this mobile phone company sells the mobile phone along with the connection. And there's a complete package for that, as many companies do. And like according to IFRS 15, you know very well that okay, if the company is having a complete package, because this is the goods and this is the service, the company should identify different performance obligations within the contract, as you have studied in IFRS 15. The company should identify different performance obligation, first of all, and revenue is recognized when performance obligation is met. So this is the treatment. So what is the risk? At the planning stage, you are going to keep this risk in the mind that there is a risk that revenue may be immediately recorded. Revenue may be immediately recorded rather than over the time. You are not sure whether they have not recorded for the revenue correctly, but you are just keeping this risk in your mind because ultimately you at the substantive stage you have to test those things. So if you are not keeping this risk in your mind, then you will not be testing that thing. So at the planning stage of the audit, just keep this thing in your mind that you are being skeptical and you are looking for the areas which may have the material misstatements, and you are preparing the list of that, a checklist, just to make sure that you will be checking all those things which may have the material misstatements, and you will be gathering evidence on all those things which you have identified at the planning stage of the audit. So let's summarize it. That audit risk is something risk in the audit. Risk in the audit means that the auditor may give an inappropriate opinion. How the auditor may give an inappropriate opinion? The auditor may give the inappropriate opinion if the financial statements may contain a material misstatement and those material misstatements are not identified by the auditor. So how the auditor going to reduce this risk? By taking the complete understanding of the entity and identifying those areas which may have the material misstatements, and later on gathering the evidence on that to assure that the risk which he was having at the planning stage is not that case. So this is something you are going to do at the planning stage of the audit. All right, so whatever I have said so far is something that at the planning stage of the audit that you are going to identify the areas which may have the material misstatements, and at the substantive stage of the audit you are going to gather the evidence on that to confirm whether this risk is actually a case or not, because ultimately you will be gathering the evidence to support your opinion, and if you are not able to identify those material misstatements, then the auditor may give an inappropriate opinion. So the simplest way of identifying the material misstatements from the question is that see the question, bring the accounting treatment in your mind, and then think vice versa. Like for example, if you are saying that the company has disposed their non-current asset, this is something which is written in the case study. Bring the accounting treatment in your mind. The accounting treatment is that the asset should be removed from the asset register and the gain or loss should be charged to the statement of profit or loss. Now think vice versa. There may be the risk that the assets which are disposed are still included in the non-current asset register and the inappropriate gain or loss may be charged to the statement of profit or loss. Say for example, it is written that the company's inventory has been damaged. So now bring the accounting treatment that according to IS2, inventory should be recorded at lower of cost in RV, and if the damaged inventory has no value, it should be written down. There is a risk that the inventory is still recorded at cost rather than NRV. So the simplest approach is to bring accounting treatment into your mind. Similarly, there may be some journal example, such as for example, if they are saying that the management is not performing the bank reconciliation on time. So that means if they are not performing bank reconciliation, so there is a risk that their cash and bank balance may not be appropriate and it may have some unadjusted differences. Say for example, if they are saying that they are not doing the control account reconciliation, so there may be the risk that their total receivable and payable balances may not be correct because they are not performing the reconciliations, control account reconciliations. So whatever is presented in the case study, just bring the relevant accounting treatment into your mind and think vice versa, think other way around. Like if the treatment is not done correctly, then what may be the risk? So this is the best approach to deal with the audit risk. And if you are done with this understanding, then you are done with the 20 marks because this is the most easiest area of the F8 exam. Abraham is a question number 146, and let's go to the requirement first. As I said that the requirement is going to be using the information, identify and describe 5 audit risks and explain the auditor's response to each risk in planning the audit of Abraham's company. Just like the ethics, when we are doing this question, we will be putting 2 lines. Here we're going to write the audit risk, and then we are going to write the response. So the audit risk and the response. Abraham's company develops, manufactures, and sells a range of pharmaceutical and has a wide customer base across Europe and Asia. And you are the audit manager of Nate and Company, and you are planning the audit of Abraham Company, whose financial year end is 31st January. You attended a planning meeting with the finance director and the engagement partner are now reviewing the meeting notes in order to produce the audit strategy and plan. Revenue for the year is forecasted at 25 million. During the year, the company has spent 2.2 billion on developing several new products. Some of these are at the early stages, while the other are nearing completion. The finance director has confirmed that all projects are likely to be successful, so he's intending to capitalize the full 2.2 million. They have spent 2.2 million on the development. So first of all, you are going to write the case study line. Okay. The company has spent $2.2 million on the development of some products. Some are at early stages of development and others are nearing completion. The finance director intends to capitalize full amount. According to IAS 38, development cost should be capitalized if the criteria is met. There is a risk that some products may not reach the completion stage there's a risk that some products may not reach the completion stage assets may be overstated if full cost is capitalized. Once products have completed the development stage, Abraham began manufacturing them. At the year end, it is anticipated that there will be significant level of work in progress. So work in progress is actually the inventory, and to determine the value of the work in progress is actually a technical thing. There is a risk that the auditor may not be sufficiently qualified to value the work in progress and the inventory may be overstated. Similarly, if you see, let's jump to the other part. In order to fund the development of new products, Abraham has restructured his finance and raised 1 million through issuing shares at premium. So if the company has issued the shares, it should be split between share capital and share premium. There's a risk that the correct split is not being made. 2.5 million through a long-term loan. There are bank covenants attached to it. The main one relating to the total level of the assets, like the company has taken the loan from the bank and they have attached some condition that you have to meet the minimum level of assets. There's a risk that in order to meet those bank covenants, the company may manipulate the assets. So this is something that is related to the audit risk, that you will be given a question. What you're going to do is to see the case study, bring the accounting treatment in your mind, and think vice versa. Think what can go wrong in the financial statements, risk of incorrect accounting treatment. Just you have to do this at the planning stage of the audit.